Today, we are excited to highlight Purppll's investment-ready journey, how they secured investment to accelerate the impact of social entrepreneurs, and how they support impact leaders to build enterprises and initiatives that address the root cause of systemic inequality. And also, we will get to learn more about Purppll's journey to become the co-owners of Thrive Impact Fund. This webinar is part of the Investment Readiness Programming at Social Innovation Canada in partnership with Employment and Social Development Canada. The goal of the program is to grow and strengthen the social innovation and social finance ecosystem by providing information, opportunities, resources, and connections that will help social purpose organizations become investment ready. Stay tuned for more of these webinars. You can also sign up for our social finance newsletter to receive up-to-date information. In terms of the overall flow of this session, there will be a brief presentation by Andrew Greer, the Managing Director and co-founder of Purppl, and also the Interior Lead at Thrive Impact Fund. Following the presentation, there will be an engaging panel discussion with important insights and perspectives from the rest of the speakers. There are also some polling questions just before the panel begins, so we encourage you to kindly participate in that. We also have an audience Q&A segment at the end of the panel, so please add your questions in the chat box. Just some additional housekeeping notes. We have live French language closed captioning available. For those of you looking to have this feature visible on your end, you can select the Show Captions on your screen and click the up caret button to select Translate to and choose your desired language from the drop-down menu. As a reminder, this session is being recorded, and if you experience any technical difficulties, please reach out to my colleagues, Alex and Kathleen, using the chat feature, and they will be able to assist you. We also have a very short survey at the end of the session, so please kindly stick around for that and take a few seconds to fill that out. So without further ado, I would like to pass on the virtual mic to Andrew to get us started. Thanks, Andrew.
Thanks, Muska. All right, I'm really excited to be joining today for this conversation. And my name's Andrew. I'm joining from the unceded and unsurrendered territory of the Okanagan Silk people. And I am very privileged to be joining from this region. It is, I think, really important that we're having conversations like this on this land known as Canada. And I think this is really aligned, or I have learned this is really aligned and in sync with the First Nations that we're getting to know here in the Okanagan region and beyond, and couldn't be more privileged to share that journey with lots of people. So thank you for this opportunity. We're going to chat a little this morning about Purppl as well as about Thrive Impact Fund. Both are quite interrelated and linked and have started really for some of the same reasons. So we'll start with Purppl first and then talk a little bit about Thrive. We're in particular about both. We're going to chat about how impact measurement happens and our investment readiness journey. So to start with, this is as close as I could come up with an image that represents why Purppl started. I was really deeply, and I still am very deeply concerned about climate change and climate justice. And the more I got into it, the more I felt frustrated and a little bit helpless. You learn a bunch of things when you get into almost any social or cultural or environmental change initiative, and you start to realize that it's all intersectional. And you can't really put solutions forward about climate without also working on racial equity or gender equity. You can't solve climate change really without working on homelessness and housing and income inequality. And so I came to this movement really because of climate change and started to realize that it's about everything. And it's hard to just focus on one. So as I got a little deeper into it, some really smart people started talking about and have been talking about for a long time how climate change is really a result of an economic model that's deeply extractive both from people and planet. And that's really what sort of focused Purppl and me on social enterprise as part of a solution to the climate crisis. It was very quickly sort of like evident to me that I couldn't really move anything forward around climate if we didn't solve or change the extractive economic model, which many people, most of North America and beyond, is working under. So that was really why and where it came from, was climate change related to capitalism, and really need to change the fundamental economic model upon which our organizations and people thrive, because we're not really thriving. So there is a really large and deep movement around social impact and social change happening in Canada and beyond. It's really hard to put numbers behind social enterprise in particular as a sort of like type of organization, because it doesn't really have legal standing in Canada. There isn't a legal sort of representation of what a social enterprise is. It really is a movement. And so there's a few pieces that sort of combine to show us that there is a movement. One, you can feel it, and that feels nice once you get into the work. But we do have the largest nonprofit economy in the world. It's $176 billion contribution to Canada's GDP, which is about 8%, and that's nearly as big as oil, gas, and mining combined. So pretty big. There's a lot of jobs in the sector, 170,000 nonprofits and 2 million people employed. That is several times more than oil and gas. So there's a lot going on in, let's say, the social sector writ large, and not every organization identifies as a social enterprise, and social enterprise isn't a solution to everything. That's okay. It's not a silver bullet for the system problems that many of us are working on, but it is part of a solution. Another piece that really sticks out is the movement of money. And we have, here in Canada, we have over $3 trillion invested under an ESG screen, or put through an ESG screen. And while I, along with many others, have some criticism of the ESG movement, it's kind of like, in some ways, it can be light touch impact and not really getting to the root cause. Where I find inspiration is that it's a signal that people care about purpose, and there's nearly insatiable demand for money going towards purpose, as long as we can actually demonstrate real purpose and a little bit of financial return as well. So numbers like this combined really add up to me seeing and feeling, and many others, that there is a movement around social impact and social enterprise. So let's talk a little bit about Purppl and sort of where we go with raising money, because that really wasn't on my agenda, when I got fired from my last job prior to starting Purppl. So in our work, we're seeing that impact leaders and social entrepreneurs are really seeking to get to the root cause of the problems they're working on, not put Band-Aid solutions in place. They're looking to improve their own leadership capacity and their organizational capacity. They're looking to build sustainable organizations. Part of that learning early on in the journey around climate change was that I kept on volunteering and trying to organize and participate in the climate movement. And it seemed like so many of the organizations and events and activities that were happening were just kind of stuck because there was no sustainable source of revenue for these initiatives. And that is part of what drew me to social enterprise and Purppl. And the last piece is that people are really seeking to communicate and measure impact. to create credibility for themselves, to make better decisions for themselves. But these are really the things that stand out in our work with social entrepreneurs and impact leaders. So Purppl stands for Purposeful People. We really are an organization that works together with social entrepreneurs and impact leaders. And we work with those people to try to build sustainable solutions to the root causes of system problems like climate change, like gender equity. And that's really our work. We do that in 4 ways, primarily. We spend most of our effort on coaching and collaboration. So we coach directly with the leaders of organizations who are working on system problems and really help them. We also spend time in community, contributing and participating in all the ways that you might think and some you might not, like workshops, roundtables, movement building, that kind of thing. We've spent some time on connecting capital to impact, and part of that is through involving people and organizations like Leanne and Sue, who are on the call this morning, and they've been partners for a long time, and really starting to direct specific capital, in particular for social entrepreneurs who are working on system problems. In addition, we're going to chat a bit about Thrive Impact Fund, and that really is an answer to part of the capital gap. We also spend time on storytelling and advocacy. Admittedly, we're not very good at this, but we have ambition. So in our work, we've worked with about 90 plus social entrepreneurs and impact organizations. You can go take a look, but really it's quite diverse in terms of geography, impact area, size of organization. It really is us working directly with the leaders in a long-term coaching situation to help them. So a few years after starting Purppl, we really started to try to put a pin into the capital part of the ecosystem. There are major system problems at play when it comes to people raising money to solve system challenges. And we had to start doing a bunch of learning, but what we were doing was seeing that the people we're working with are generally women-led, or women. Like, women are driving the social movements in Canada. 70% of the employees in the nonprofit sector are women. And it really is a movement where capital is hard to come by. Grants and donations are happening, but generally speaking, the social sector is underfunded and working on some of the toughest problems in community. And so we started to try to understand a little bit about what social finance was and what impact investing was. And at the time, we started a fund to try to directly insert capital into the people and organizations that were leading change in community, leading system change in community, and try to add a different type of capital that wasn't really happening. So when we look at this lens of what is social finance, Thrive Impact Fund is our response to that. And it's a co-owned company. It's co-owned by Scale Collaborative and Purppl. Scale is a organization very similar to Purppl, but based out in Victoria. And we are really sort of focused in at that impact first part of the social finance spectrum. Some of our investors are even further along. They're doing community investing, for example, into Thrive Impact Fund, which is doing impact first investing. We are past sort of socially responsible investing, which is where the vast majority of that $3 trillion is invested in the Canadian market. And it's going beyond that, past sort of positive screening and moving into impact first rather than finance first investing. We operate in the capital continuum. This is a different way to look at impact investing and the capital. We come in with flexible debt. And that's for a few reasons, but one of the main reasons is that so much of the social change that's happening in Canada is driven by nonprofits. And bluntly, nonprofits can't take equity. And we didn't feel like that was the right solution based on the organizations that we work with day in and day out at Purppl. Didn't feel like equity was the right place to enter from a capital perspective. So we do have flexible collateral requirements, flexible payment terms, flexible interest rates. It really is, and even flexible ways to provide the money. So it really is tailored to each investee. We don't have a standard investment, let's say. We have 3 different ways to invest in organizations. The first 2 are relatively traditional loans, but they don't require collateral. There's flexible requirements there. You can do up to 6 years. And a early revenue loan or flexible term loan is, as you might expect, we loan the money, and there's a set payment schedule to return the money. It is an investment, not a grant. Revenue-based financing is very unique in Canada, although a little more common elsewhere. But essentially, we invest the money and it gets paid back as a percentage of revenue of the organization that takes the money. So it's very much a shared risk sort of way to get the money in. It behaves a little bit like equity, but it can go up to 7 years and up to 400,000 in investment. Or sorry, up to 700,000 in investment. So we really work in the early stage loans is really sort of under 100K, can go up to about 700. So those are really the primary 2 ways in which we invest in organizations. So a few examples of Thrive's portfolio so far to put a little bit of color to a story so far. Water Rangers is a nonprofit based out of Ontario, but operating in the West as well. And they sell water testing kits. They were looking for capital so that there wasn't such a delay in their customers buying water testing kits and then enabling them to fill the orders. So we help to provide some working capital. Nyoka is based out on the island. And if you've ever been to the island and seen bioluminescence in the ocean, this sort of natural phenomenon almost where the ocean lights up. Well, they've put this into industrial grade lighting, focused first on the fishing industry, but the difference is that it's reusable and non-toxic. Whereas think of the alternative, which is essentially a glow stick in industrial uses, which is single use and plastic, and they get disposed of immediately. Well, this can be recharged and it's non-toxic. Nada is a package-free grocery store. Ecologist is a clothing company, not unlike let's say Patagonia, but based here in BC. A little different, of course, but the same principles and values behind them. And Amiki is an Indigenous-owned technology company. They build and basically build websites. And Make House is a sewing co-op, kind of like a maker space for sewing and fabrics. And they bought this. The workers formed a co-op and bought the organization from the former owner. So we provided a bit of capital for that transition. So that's a little example or a few examples of Thrive Impact Fund. So getting to the heart of the conversation today around impact measurement and our investment journey. So Garth, I saw you're on the call today. Thanks to all your work over at the Common Approach and building foundations like this. So these are the 5 essential practices of good measurement as shared by the Common Approach. It's a Canadian organization really that went out around the globe to find wise practices of good measurement. One of the differences in the way I would describe it is the common approach isn't telling you what to measure, it's telling you how to measure, not telling you, but sharing wise practices about how. And these are those 5 practices, and this is how we measure at Purppl. This is how we measure at Thrive. Both our organizations are using practices like this to do better impact measurement. When we talk about what we measure, we really focus on outputs and outcomes. There's a real desire for many organizations to shift from measuring outputs to outcomes. And this is our theory of change, which really is the starting point of good measurement. If we go back for a minute, these 5 essential practices are really nice and simple. They're simple to understand and simple to do the minimum, but hard, if you really get into it and do it well. But those 5 practices, the first one is to describe your intended change. And the way that is really communicated is through a theory of change. And then you select some measurements or indicators, you collect the information, you analyze it, and then you communicate it. It's really quite straightforward in principle, harder to do in practice. But this is where we focus. We have focused first in our measurement around helping organizations build sustainable and regenerative business models. We focus our measurements really around their self-generated income, the diversity of revenue that they have in their organizations. So we're not measuring all of this yet. It's too much for us. We're not there yet. Maybe we never will, but this is our theory of change, and this is what we expect. This is what we expect will happen. This is what we are planning and trying to achieve. So that's really from an initial sort of question around what we measure. It's really these outcomes. That's what we're trying to measure. And we are, of course, measuring some of our outputs as well. But a theory of change really simplifies and narrows what you should be measuring. So here are some of those numbers. About 70% of the organizations, this is an output, about 70% of the organizations that we work with are women-led. 80% of those are incorporated as nonprofits, while the balance being for-profit and co-op. Most are serving marginalized populations. And where things start to get interesting is really around self-generated income. So most of the organizations we're working with, despite being mostly nonprofit, almost all of their revenue is customer driven. And so that could be contracts. It doesn't necessarily mean traditional customer in the sense of customer, but a lot of it is government contracts. But importantly, it's not grants. And that revenue stream is growing about 35% year on year for these organizations. So what we don't do is we don't take credit for that growth. We're not there yet in our measurement to take any credit for it. It really is those organizations doing that work. Sure, we can logically say that we're helping in the mix, but we're not taking credit for those changes. So our investment readiness journey. This has been a journey, let's say. And Purppl was founded or started in 2015 when I got fired from my last job. And that was a really humbling experience, and went out immediately and asked and shared with a couple of friends and said, I'd really like to see if we can start coaching programs for social entrepreneurs. And they both said, sure, you should do that. There aren't jobs for that. And they each gave a very small loan, and one was then paid back out of revenue as we grew a little. And this was 2 $5,000 loans, and the other was paid back a few years later. So both were at 0% interest, and extremely friendly on terms. So I didn't realize when I got fired that I was, going to take on capital right away. It didn't even feel like, to be honest, it didn't feel like if I failed, I would have to pay those back. It was more just like a good luck, Andrew. We think you can do this. And they also became co-founders of the organization. They are no longer actively involved, but that's where it started. About a year and a half later, after some early learning about getting customers, we actually incorporated. And when we did that at the credit union, we asked for a line of credit, and we got one. It was backed, of course, with personal guarantees because we had no business history, but we got a line of credit right away. Fast forward a few years later, there was this thing that happened in 2020, this pandemic, and everyone was really nervous in 2020 about what was to come right around March. And so we went and again asked for a bit more money from the credit union and got some because of the uncertainty related to climate change or related to the pandemic. And that really was an eye-opening experience of getting some additional capital. We changed a few things right away, but one of the things we did a few months later was to hire an additional staff member. We were only a team of 2 full-time at that time, and then added a third role. And we wouldn't have done that if we hadn't raised capital. So that was a sort of eye-opening experience around getting external capital. We also, in 2020, started trying to build an impact fund. We had started in 2019 and actually raised the first commitment of equity, an institutional investment of $750,000 from Interior Savings, which is a credit union here in the Okanagan. And that was kind of surprising in 2020. We had signed agreements in early March of 2020, and a couple of weeks later, everything shut down. We came back a few months later after we kind of surfaced a little bit and asked the CEO at the time, do you mean that? Are you going to stand behind that investment? Because we weren't sure based on how so much changed. And she said, yep. And she stayed committed. So that was a really strong commitment at the time for an unknown really organization and startup that we called Lime. It was a local investment fund. At the same time, our friends out on the island were also trying to build a fund called Thrive Impact Fund. And we were doing some learning along the same time as they were, and lots of sharing. And in 2021, we together decided that it didn't make sense to have 2 local place-based investment funds in BC. And so we shut down Lime, which was launched here in the Okanagan, and thankfully convinced our institutional investor, Interior Savings, to bring their money over to Thrive Impact Fund. And so we had about a little over 1.5 million put together by 2022, made 5 investments in that second year of Thrive Impact Fund. And now in 2023, Thrive has already added an additional $1 million. We're at about $3.5 million invested. And we have plans, and I expect we'll hit them, to raise an additional 1.5 by the end of this year. And on the Purppl side of things, we have just committed to our first direct loan, trying to do a little bit of direct investing ourselves. We received an IRP grant to continue to explore and build our own investment readiness, and have started to explore what social purpose real estate and employee ownership mean at Purppl. So it's been a journey over several years to get here. It barely feels like we've begun, but it's been filled with a few different types of capital. So some of the learnings in the work, whoops, trying to play around with Zoom screens over here. So some of the learnings here, the first one that really stands out is that this work doesn't happen alone. while we had started an impact fund called Lime in the Okanagan with a few other partners, it really feels so much stronger to be doing it alongside the team at Scale Collaborative. And I think we are definitely more likely to be successful by working together. So that's been a persistent learning throughout the last almost 10 years. I had come out of the tech sector before working in social impact, and I was used to angel investors and venture capital, and it was just like, it felt a little bit ugly and didn't really fit into the social landscape that well. So I've learned that patient capital does exist and friendly capital does exist. And the last pieces here is that the impact model and business model fit together. That creates abundance. I can't tell you the sort of colonization, racism, sexism that we continue to see. Thrive is a woman-led fund. I am not a woman. I am a privileged white male, let's say, and I can see it and feel it daily in the people that we work with. And I'm just going to wrap it up there in respect for time, but been a few other learnings along the way. And I'll welcome Hilary over into the conversation. I'll stop sharing for now, but thank you very much for listening, participating in the conversation, and I look forward to opening it up a little more for conversation in the balance of the conversation today.
Thanks, Andrew. Thanks for sharing your story. My name is Hilary Henegar, and I'm also at Purppl. I'm a brand and communication strategist and also an entrepreneur in residence who coaches and collaborates with the amazing social enterprises, mostly in BC. And so I'm here very privileged to be able to join you from the unceded traditional stolen territory of the Coetball people on Vancouver Island. And I'm going to be joined here by with Andrew by others in unceded, unsurrendered territory in Okanagan Silk territory, by Sue Manzuik and Leanne Hammond. Sue is a community engagement specialist with Interior Savings Credit Union with over 25 years experience in marketing and communications. Her work is focused on grants, sponsorships, and community impact partnerships, including Thrive Impact Fund and Purppl. And so she's joined here too with Leanne Hammond, the executive director at Community Foundation North Okanagan. She has 25 plus years in nonprofit management, with 20 of those years in the philanthropic sector. Leanne's passion is finding creative ways to make social change. Thanks to you both for joining. We do have regrets from Christy Fairholm-Mader, who is also with Thrive. She's the managing director there, and she's the director of innovation and initiatives at Scale Collaborative. Sorry not to have her here, but maybe we'll just kick off the conversation with Leanne and Sue, who could perhaps share with us about how they first came to learn about Purppl, and why partner with Purppl.
I'm happy to go first. Hello, everyone. It's a pleasure to join you from Silks Okanagan area. I think that in a smaller area, and this may actually work in larger cities as well, you tend to sort of trip over the same cast of characters over and over when you're passionate about something. So I first met Andrew when we were both volunteers, and then Sue actually joined us too at some point in a long ago story called Okanagan Changemakers. And then you go on and you do your own work, and your volunteer stuff just kind of carries on along the side. And eventually your paths just keep crossing over and over and over again. So when Andrew started up Purppl, I think there was a recognition in our area that, yes, it was time. This was the type of organization that we need. And for me, especially being involved in foundation work, we grant to organizations that are trying their best to make social change. So to have a social enterprise accelerator that is actually walking along beside them and giving them the leadership skills, coaching, kind of business acumen to make those social changes happen was the timing was perfect. And so, of course, as a community foundation, we were extremely excited to see that type of support going on in our area.
Yeah, I think, you know, there was certainly some community awareness of what Andrew was doing. I think from a interior savings standpoint, at least in my role from a community engagement perspective, the relationship really began with a sponsorship request. And it kind of triggered this bigger relationship where now, you know, we share resources and opportunities, and over time it's grown into something far beyond that sponsorship application. In terms of factors that we consider at Interior Savings, we're focused on some key areas, but the overarching theme of that is really building sustainable, inclusive, resilient communities. So we look for opportunities that are going to make a lasting difference across the 15 communities that we serve. And our partnership with Purppl falls neatly into one of those pillars called cooperative economy. And that's focused on helping build a strong and supportive ecosystem for social purpose organizations.
What are some of the, what sort of impact are you hoping for by partnering with Purppl and investing in Thrive?
Well, starting off with talking about Purppl first, and then I'll talk a little bit about Thrive and how it neatly kind of fell into the path. When we're making grants as community foundation, we make grants, as I mentioned, to organizations that are trying to make social change and that are making our communities a better place to live. Those grants are, you know, sometimes a small amount of money, sometimes a fairly substantive amount of money. The organizations themselves know exactly what they're trying to do and know best how to accomplish that. But we do find that there are times where organizations ask us specifically for kind of core support for actually sharpening their own tools, to borrow a phrase, and that what Purppl did and continues to do is to provide that level of support. And that's the type of thing that so we actually started, I think our first kind of investment in Purppl was an investment in our own organizations that we were supporting through our grants. So various different partners came together, started a small fund that organizations apply to every year. And right now we're calling it the Impact Leadership Development Program. And we all kick in an amount of money, the community foundations in our area, the financial institutions, Sue's organization, Interior Savings, to provide organizations with the money to work with Purppl. And they have to put in some of their own money too, to be able to learn about leadership development and innovative ways to do things. So that's first and foremost. So that was kind of our first introduction to kind of putting some money where our mouth is as far as really helping organizations learn. And then when Purppl got involved with Thrive, you know, Andrew had success, I think, you know, tried really hard with Lyme, but saw that it would be much better to come together and to have this cooperative thing with Thrive. We were actually looking for a place to put our toe into the pool to be able to walk the talk more around making investment in things that we can see are actually moving the needle and are working directly on root causes and trying to do things in a more innovative way. So it was just really, I think, an automatic that investing in Thrive Impact Fund would be a wonderful way to kind of augment what we do as a community foundation in our area. And so we're thrilled to have been actually the first community foundation to make an investment in Thrive Impact Fund.
Amazing, thank you. Now, a question that we were considering is around as investors, considering like how could investors improve their due diligence process? I'm sure there's folks in the audience who are curious and they're on their own journey. Andrew, what would you say to that?
Well, that's like an interesting question. Raising money for an impact fund means we're going through a due diligence process ourselves when investors invest in Thrive. And then shortly thereafter, we're then deploying the money with organizations who Thrive is investing in and alongside. So it's been like a bit of a split journey on understanding kind of both sides of it. Some of the learnings so far around improving it, and I don't think Thrive has got this perfect yet either, but some of those improvements, I would say, include having a clear and transparent process, and in particular, a timeline, so that you can get a clear yes or no. Those would be the most important words to get, yes or no. And a maybe is kind of like the worst answer you can get. So that would be the sort of biggest one. But some of the more nuanced improvements in a due diligence process that we're feeling as a small impact fund are reduce the asks for immaterial legal changes, because we then have to go back and communicate all those changes to the other investors as well. And we don't have a big legal budget, of course. And it just sort of creates a bunch of work that doesn't necessarily improve the situation. But yeah, those would be a few short answers.
Great. And when are your investors, are they looking to hear reports on measurement? Do they want to know about impact?
Yes, indeed. So there's sort of two ways to go around the measurement. And this has been one of the learnings around impact investing in particular, is most impact investors that we're coming across have some understanding of what impact means, but they also have a lot of learning still to do. And so what we're finding is that the investee is actually in a pretty influential position to define what good measurement looks like for an investment rather than the investor. So in our case, that means at Thrive, we can define that for our investors, and our investees can define that for us. And that's a really humble practice. Again, giving credit to the common approach. Their approach to measurement enables a fund to define outcomes, but not the specific indicators that have to be measured. And it allows different investees to choose different indicators that align to defined outcomes that we're collectively trying to achieve. And so yeah, that would be kind of part of the measurement approach.
Leanne and Sue, as Andrew mentioned at the top of his presentation, basically all root causes of social environmental problems are intersectional. I'd love to hear from you both about how diversity, equity, inclusion factor into your investment decisions. Are there metrics that you look for?
Sue, do you want to take that? I feel like I'm taking a lot, but I have stuff to say.
Sure. I would say that, I mean, we're a member-owned cooperative organization, so certainly DEI is top of mind. We are an organization that is learning around metrics, and I think Andrew articulated it incredibly well that, often they're in a position where they're working together with the investee to determine what those metrics look like. So, from our perspective, we certainly aspire to learning more about that metrics and how do we measure. And we've done some work with a common approach work, but we're really only in the beginning stages of that. So we really work together with our partners to try and grow that capability and that understanding. That would be kind of my short answer, Leanne.
And to add to that, I think that as a community foundation, we've always measured on the side of our granting involvement defining outcomes and what people are aiming for. And I also agree that it really, the indicators and the impact need to be defined by the grantees. Same in this world, we need to really look at kind of how we're measuring the impact of things. But just to add in, I mean, everybody's quite familiar by now with the, the criticisms of the traditional investment model, which is to make money over here in your traditional in your traditional investing portfolio, and then take the money from that side and then go do social good over here. So starting to overlap those, I think, is a really exciting way to shift that model out of the kind of traditional and easily criticized model and into something that is in and of itself generating good social impact. And so DEI is a major part of what we're starting to do in traditional investing, and we're seeing those words. The fact that everybody recognizes that is a step in the right direction. But as Andrew said earlier, I think that how deep that goes is still, the jury's still out on that one. So being able to invest in something that is really, it's in the DNA of it, is really exciting for us. And so this was a no-brainer as far as being able to put some of our capital into this venture.
Amazing. I'd love for you to kind of continue on that front, talking about how do you balance financial and social return? What advice do you have for social purpose organizations on creating that balance within their own organizations?
The first thing I want to say is that don't mistake that, we're heavily into this. We've just put our toe in the pool. And so we're not what I would consider the biggest leaders. There's community foundations across the country that are really doing this in a much bigger way than we are. But for medium-sized ones, I think this is a very easy first step. And the due diligence part of it that you were touching on is done by Thrive. So Thrive really de-risks a lot of the investments that we would want to make in our province, in our communities, and does that due diligence and is very capable of doing that work. So that's really exciting. And I know that a lot of investors are wanting to start thinking about doing direct impact investing in their own communities. And that can be really rewarding and exciting, but it can also be scary in knowing how much to take on. And so this for us was a really nice way of working with other partners like Interior Savings, like other community foundations or other funders in our area to kind of do things together. Learning from each other, keeping good company is kind of the root of all of this. And I think that this has great potential to be a great mechanism for us and to co-invest with Thrive Impact Fund or with other groups in our area to be able to kind of send along deals or things for Thrive to look at in our own areas. So that reciprocity back and forth, I think, is really exciting.
I would say from our perspective, our ability to play an active role in our communities comes right down to the support that we receive from our members. And we know from member surveys that 1/3 of our members choose us primarily because we are active in our communities. There's another 1/3 of our members that, when all things are equal, our involvement in community is that tipping point for them in terms of them doing business with us. So I would say these numbers aren't unique. There is a growing body of evidence that purpose-driven organizations can find that balance and can be very successful. They tend to attract the talent. They are able to retain them. They're sought out by consumers and by partners alike. So the research is out there. So I don't think it's an either or anymore. In terms of advice, I think it's really just being clear about what you want to achieve and what impact you're trying to create, and use that clarity to make decisions across the organization to align yourself with partners where it makes sense.
Thanks. Along the same lines, Andrew, given that you've learned a lot in this journey, and I'm sure there's lessons learned that you could share with folks in the audience. But also would love to just sort of acknowledge that not everybody has like a couple of buddies that are just going to offer them like a 0% interest loan. Not everyone has that privilege. So would just love to hear like what are some other ways that folks can get started if they haven't already, but also just any sort of specific advice that you would have for folks who like you are on their journey and looking for investment.
There's not really an easy way, I've found. The most common story we see around people who are trying to start impact organizations is that they're either working full time and this starts as a corner of desk priority outside of work, or they're doing a bunch of contracting or consulting or other kind of part-time gigs so that they can have a bit of time to do impact work. It seems that's a common story. Further, for nonprofits, it seems there's a way to slowly build a bit of traction over time, getting grants and donations to support a nonprofit or charity getting started. But to be honest, it doesn't seem like there's a fast way to build a sustainable impact organization. And in terms of what I would maybe consider early in the journey is including a diverse mix of revenue. And Purppl isn't really set up that well. I think we'll talk about this a little bit more, but Purpple's a community contribution company, and we're not really set up to get grants, and we're not set up to get grants and donations. It really has come through partnership and customer revenue. And a nonprofit is actually better set up for diverse revenue than a 3C is. But that would be a place to start, is from the ground up, consider what grants, donations, and philanthropy can mean, consider what contracts can mean, consider what customer revenue can look like, and potentially crowdfunding, that kind of thing. But that would be the guidance, is start with some revenue diversity in mind.
And maybe to all of you, what advice do you have for social purpose organizations who want to be considered investable by organizations like Thrive or Community Foundation or Credit Union?
I would say keep at it. Don't give up. Reinvent yourself constantly. If you know intuitively that you're making a difference, find different ways for funders to be able to invest in your success. So don't get discouraged easily. We found a way Purppl found a way for us to be able to invest in them, even though they couldn't take grants or weren't in a position to kind of, they just, when they came back with, I think, and made that kind of approach where they said, we want to support the very charities that you're actually granting to. We want to make them stronger. Then all of a sudden we had something that we went, hey, that works for us as funders. So like Andrew was saying earlier about the model, the impact model, think about the impact that you're trying to make and then come at it from various different avenues on how you can do that and how you can partner with various like-minded folks to make that, and just be constantly learning, listening and learning and reinventing.
And I would add to that, and I think Purppl and Thrive are such a great example of this, is really finding that community, right? There's a growing number of organizations out there that want to put their values into action, funders, the like, and I think that developing and nurturing those relationships are incredibly key to all of this. You never know the conversation that you might have with somebody that leads you into something else that you never even considered. So I would say, yes, it requires a lot of work, but I think that that's an area that is worth putting that investment in for sure.
Andrew, when Thrive invests, what's it looking for? How do your investments work?
Thanks for that question. We talked a little bit about how the investments work, either a relatively traditional loan or a very non-traditional revenue-based financing. So that's how they work. What are we looking for? We're not a startup funder, that's for sure. We're looking for organizations that have at least a year of customer revenue and can clearly demonstrate an ability to repay a loan. And so that likely means you're either at break even for this project or can demonstrate how it will be fairly soon. We don't have let's say we're impact agnostic. We don't have specific impact areas where we're seeking to play a role. It's more of a response to community needs, primarily on the island or Vancouver Island and the BC interior. And we are in particular set up and looking for more nonprofit investments. The nonprofit sector compared to the for-profit impact sector is there are more systemic barriers in place to getting different capital in the nonprofit sector than there are in the for-profit sector. For-profits are used to raising money in this way, and nonprofits aren't. And there's a tremendous amount of reluctance and sort of hesitancy around risk for nonprofits. So we're definitely looking for nonprofits and co-ops to invest in, including for-profits. But that's what we're looking for. The last piece I would add, sorry, is around female leaders. Thrive Impact Fund is female-led. It's unfortunate that Chrissy couldn't be there today or be here today. She's meeting with the Premier of BC this morning. And, you know, she's done a wonderful job, her and the team. Emmeline's on the call here too. She's our impact investment manager. And most of our investments to date are in women-led organizations. And there's just straight up less money going into women-led organizations. And if you're brown, black, Asian, or anything other than white, you also have a really hard time raising money on top of being a woman. So there's a clear priority for that at Thrive Impact Fund.
So Leanne, I know that the community foundation movement is starting to sort of facing a bit of a reckoning and starting to be more honest about some of the challenges and where the money has come from and how it's used. I just love if you could share a bit of context about that.
Okay. Sure. Like I was starting to talk about a little bit earlier, I think that endowment-based organizations are doing a lot of work right now about looking at kind of how we were started, what the whole meaning of philanthropy is. Philanthropy was based on, to be blunt, rich industrialists back wanting to kind of give back in a lot of ways, but how the money was earned, how it was, those are all really deep discussions that need to go on in community foundations, private philanthropy, family foundations, et cetera. Our organization has been around for about 40 years, going on 50 years, and we are very interested in looking at how we can help redress issues, how we can look at social inequality, and my background as a sociologist fits beautifully. So I've always been pushing the envelope on that. Let's look at social inequality. Let's look at how we want to change things. Why? How did it get this way in the first place? And my colleagues at community foundations across the country and throughout the world, I think, are looking and grappling with these issues. As we, my fantasy basically is that we start to kind of bring it all together. And I felt for years like there was a lot to be done on that traditional investing side, and I do see movement. I do see a lot of change in how the traditional side is starting to approach investment. There's also a move around, do we endow? How much do we endow? How much do we get invest? If we could get our are endowed investments working for us to actually earn income in our organizations that are actually generating positive social change, that's where really we're then utilizing and mobilizing all of our capital. So that's kind of the types of things that community foundations are grappling with, and groups like Thrive, and in individual ways that of investing in our local communities really opens up a whole world of opportunities for us.
Amazing, thank you. I'd love to open it up to audience questions. And sorry, Muska, if you could remind me, am I reading the questions, or do we want to let folks open up their mics and ask them themselves?
Hi, thanks, Hilary. If you could kindly go over the questions, that would be great.
Sure.
Great.
I'm not going to do any voice impersonations or anything, so I'm just going to read in my voice. So Mariana asks, did you have any resistance from social purpose organizations shifting from a grant mindset to a loan equity approach? And how did you address it?
Yeah, there's a tremendous amount of resistance to that. We find less resistance to that for for-profit impact companies, tremendous resistance to that in the nonprofit sector. The problem, I wouldn't say starts and ends with the boards, but there's a tremendous amount of risk mitigation done by boards, and quite a bit of discomfort from a board perspective to allow a nonprofit to take on a loan. Oftentimes that means the board member has to put a personal guarantee in place, which is just like it's a non-starter. I've been in that position before as a board member for a small startup co-op, and it was just kind of ridiculous, the hoops we had to go through to get a $10,000 loan. What we ended up getting one credit union to say, well, we'll give you this loan that can act as a guarantee for this other credit union to give you the loan. And it was like, really, this is the loophole. So yeah, there's a tremendous amount of resistance. There's not one solution to this. I think we got a long journey ahead of us as a sector risk doesn't have to be a bad word all the time. So maybe we need to reframe the language a little bit around what it means to take on investment capital. Certainly one of my learnings as a social entrepreneur has been, I can do more faster. Not necessarily that faster is always good, but I can do more, and it actually feels better to have someone else's capital in here working with me. I couldn't be where we are today without the capital that we've taken on. So yeah, short answer, there's a tremendous amount of resistance in the sector.
Can I just comment on that, Hilary, before we move on? I think that, as Andrew said, I think part of it is reframing the language around how we approach it, because there are a lot of enterprising nonprofits, to borrow a phrase, that are doing a lot of really good, solid work that could be ready for investment, but that don't recognize themselves as being in that position. And there are charitable groups doing great work that actually have that could actually even secure loans, but that haven't thought that way. They do own equipment, they do own, and they have a track record of years and years and years of positive returns, but they just don't look at it that way. Those are the groups that I think could be the first groups that get an investment, if their boards kind of shift and look more at the way that they're doing things. They have earned revenue, they have earned income. And then there's other groups that are just doing incredibly good work that are grassroots, that are small, but as soon as they have a little bit of traction behind them, maybe don't have as much that they could put up as collateral per se, but are, you have, as soon as you have a year or two of some metrics that you can turn to, that you can can look at, that's when you can start reaching out. You can also start your journey by working with groups that can lead, mentor, work towards down that road. And there's other charities that will never be in a position where they can live on anything other than grants. And they're not built that way. But any group that has, I think, the ability to have some predictable earned revenue in their model could shift the way that they look at things. But it's really shifting the way that the staff and the board think about what they're doing.
Well, I'd love to actually kind of follow on that. So for anyone in the audience for whom they might be facing this exact issue and have a board who is quite risk averse, maybe if any of you have any tips or examples that you could share of how to shift that culture. Andrew, you did mention in your case study that the culture around finance has shifted in the leadership of Purppl. Maybe this is referring to that, I'm not sure.
So in our work at Purppl and at Thrive, I would say one of the easiest ways or helpful way to start to shift the board culture is to have somebody else come in there and talk about it. I don't know why, but it's terrible, and I face the same problem. But it seems like if you go to tell your own board something, they might like dismiss you. But if some other quote expert comes in to talk about it, somehow it's okay. And you just look over there and you're like, well, I just said that, and I've been saying that for a year or whatever. So that's sadly a partial solution.
I think that goes back a little bit to the discussion around keeping good company and surrounding yourself with other leaders in the space that, first of all, can demonstrate how this can work. I think that when we see someone else making it work and they come to speak to our group, it does actually bring about that credibility. And it shows people how not to be as afraid of stepping out into the space and that it can be done. So I totally echo what Andrew said.
It sort of normalizes it as well. So there's a number of questions related to Purpple's being a community contribution company. Yusuf asked, how does being a CCC impact your ability to get grants, financing, or funding in the current landscape?
Yeah, good questions, Yusuf. There's a lot there. Community contribution company is not very well known. It is not, there's not a lot of reasons to do it other than credibility. And you kind of have to build the credibility by educating those close to you about what a community contribution company is, or a 3C. There was a question of, does it affect our ability to get grants? Yeah, there are grants available to for-profit companies. So that's a thing. There are many, many, many small business grants out there. And so it's a misnomer that you can't get grants as a for-profit. It's just different grants and different funders. So yeah, we can't get a direct grant from some of those charitable funders, but we can get other ones. We haven't been successful at that. The IRP grant that we just got, to be honest, is the first direct grant, I would say, from provincial or federal government. But we've done really well to build strong partnerships with organizations like credit unions and community foundations that have been really, really strong partners the whole way along. There was another question about it from someone up in the Yukon. There is indeed some legislation around community contribution companies. You can go take a look. It is strictly regulated where and how the profit is distributed and what it can be spent on, and the transparency requirements around it. So it's pretty strong. It's just not well known. It's modeled from a community interest company incorporation in the UK, which is really strong over in the UK. And Nova Scotia has a similar community interest company designation.
And do you want to speak to the 60% requirement?
Yeah, so as a 3C, 60% of the profit has to be put towards the cause that we were set up to work on. And that's quite a bit different than, like, to be honest, quite a bit different than 1% for the planet, as an example, as a give back. This is 60% has to stay on the cause, not one. So it's quite a bit different. No offense meant to those who are doing the 1% for the planet thing. But there's no moving it. So if Purppl was to ever be sold, which I expect is quite unlikely, even if it's sold for $1 million, 600,000 has to go back into community. 400,000 would be a max that could go to me as the owner. 600,000 has to go to the community, and generally any charity would be a good home for that 600,000. But it's more flexible. It can go to kind of like associations. You could consider giving it to the local government, First Nations, that kind of thing.
Yusuf wants to know, if you started again, would you incorporate as a 3C again? Why, if you would?
Oh, that's complex. You know, there were a few pieces that really sort of sent me on the 3C route. One is I had a friend who also had a 3C, and I was like, oh, well, that's interesting. But I had just been fired from my job at a nonprofit, and another nonprofit that we started to do social enterprise work. After I got fired, I went to a board meeting to say, oh, we can do this social enterprise development work now, because you know what, I have a lot of time on my hands. And I actually got yelled at a board meeting saying that that wasn't why we started it. And it was like confusing to me, because I mean, that was why I got involved with that group. And so I just kind of got burned twice in pretty quick succession by boards. And so I wanted a little bit more control, and a 3C allowed for that, while also creating real credibility as a social enterprise. It wasn't just another incorporation that we could say we're doing good work, but really all the financial benefit just went to my back pocket. And a 3C, that's not allowed. So that was really why I was looking for a bit more control balanced with credibility.
Amazing.
I think
okay.
that I just wanted to add there that I think that by starting a 3C, you really baked into your DNA the direction that you were taking, and made it really obvious to any investor what the motivation is here, is to balance those two things, between having some control and being able to operate like a business, as far as being very heavily motivated, but always respecting that that 60% of the income is going to be about making your social change. So for outsiders, I think that's really reassuring. And I had high hopes for the 3C in BC kind of movement, and we haven't really seen that take off, but knowing that structure exists, there's a lot of groups that really could do well with that, but it's just not well enough known, I think.
Makes me think of
Yeah,
that
so
quote.
for nonprofits, like there are some nonprofits who either have or are considering for-profit subsidiaries for social enterprise development, and a 3C is an option for that. It's almost unnecessary if it's a charity that owns it or a nonprofit that owns it, because all the shares could be owned by that nonprofit, and thus is, you know, the money leaking out of the sector isn't really happening. But it would certainly enshrine the impact if you did incorporate the 3C.
Angela asks if can a nonprofit charitable organization that is not a social enterprise be eligible for an investment?
Yes, as long as there's a way to pay back the money. So a good example that, like, organizations, nonprofits in particular, don't often consider themselves nonprofits, but if you look kind of behind the scene a little bit, an organization that's operating, for example, social purpose real estate or housing is a good example of a organization that definitely has an ability to demonstrate how they could repay a loan, and this could operate as part of the capital mix that's needed to add to or start social purpose housing, as an example.
Randall asks, what types of leadership or leadership structures have you seen that make for successful investee ventures?
Women, we're more invested in women. No offense to the men in the room. It's pretty early in our journey at Thrive. We've only made 7 investments, so it's hard to see a lot of pattern. It's only been a year and a half. But in terms of leadership structure, in our work at Purppl, there's a few patterns that persist. But I would say one of those is that you have enough control over your board to influence your board as opposed to them controlling you. And that would be present for the same in a for-profit company. If there were investors present, it would be important that you have enough leadership to influence your board as opposed to them control you. I'm not sure if that answered the question.
Randall, feel free to ask any follow-ups in the chat. So Akil asks a question. Can we get an investment from Thrive to work with Purppl to get some strategic guidance to grow our impact? Or would that be a conflict of interest?
Technically, it could be possible but that's not what it's for. Really, that's not the intent. I would suggest there are other places to find good money to do work like that. And that said, Thrive as a funder is not going to tell you what you can and can't do with the money. Other funders, that's a system problem. They tell you what you can use the money for. We're not going to tell you what you can use the money for. But that's not the intent.
Angela asks, and this is sort of, it sounds like it's probably related to the question we were talking about the culture of the board and leadership in the organization. Does Thrive offer initial consultation with senior leaders to inform/educate with a view to assess whether investment is a good option?
Yeah, that goes back to the system problem and the risk tolerance of boards. Yes, we do. We spend quite a bit of time, let's say, in community, helping to shift the narrative and conversation around what is risk and what is impact investing and that kind of thing. So we do it in community, we do it privately with specific boards. So yes.
And then Jarrett asks, how is the balance between raising capital to deploy versus sourcing good investees to deploy the capital to? Raising capital to deploy versus sourcing good investees to deploy the capital to.
That's a fine balance. The way there's so much privilege wrapped up in this, but I'm going to share where it comes from. Myself and Christy, who's not here today, have been primarily focused on working directly with investors to try to get them to commit to invest in Thrive. We got enough early capital to be able to hire a full-time an impact investment manager, Emmeline. She's here on the call today. And so she's focused primarily on working with investees and potential investees. So the sad part of the reality is that the real way it's possible is because of the privilege that Christy and I and others on the ownership team, we can spend some of our time outside of our primary roles to do this work, developing something else. So that's how it's balanced.
I just wanted to add in on that as far as finding groups to invest in. I think that that's a place that community foundations as well as credit unions and other funders can kind of step up with putting things onto, I think, Thrive's radar. So knowing about groups that are doing good work that might fit, and then introducing them to Emmeline to be able to kind of do some due diligence and have some, for her to do some questioning and some basic work around that. So if you think that, yeah, I mean, we come across, of course, as a community foundation, we only work with registered charities or nonprofits. But Sue, you may be more aware of groups that have come for funding or that are operating in your area that could fit the mold. So I think the more of us there are kind of keeping our eye on and open to opportunities, the more we can work together to kind of build that pipeline of good things to invest in.
Yeah, I would just add that that's a really good point, Leanne. And I think as part of the launch of this for us internally, Andrew has done some work to kind of bring people up to speed in terms of, what it's all about and, how the process works and how our frontline staff that are seeing opportunities out there can get in touch. And I think that's important, because, as we've all heard, conventional financing can be challenging. But, having these additional tools in our back pocket is so helpful. And, we can then refer people and they can have those conversations. So, again, speaking to that community, right? We need those partners, we need those community around us to help make this work.
Yeah, sort of back to one of those first lessons is that we can't do this alone. The investors that we have at Thrive have been wonderful to sort of help share the opportunity, try to find the rare organizations who are really ready for capital. It's a really tough place to be, I think, in impact investing, but also a really exciting place. It does feel right now that there is more capital looking for impact than organizations that are ready to build sustainable, impactful initiatives. Our nonprofit sector is doing so much important work, but the system problems getting in the way are basically like people are underpaid. Generally, the whole sector is underpaid. Like the structures of government and economy that are set up are basically keeping the social sector in poverty. Meanwhile, we're asking the social sector to solve some of the worst and toughest, most complex problems on the planet. And, we can't just like capitalism our way out of capitalism. That doesn't work. Like, so there's just some like major shifts needed. I think Thrive is part of a shift, but we've got a lot of fundamental shifting to do, and it's exciting to see that Thrive can exist. It is not yet sustainable, that's for sure, but it can exist, it can start. And I think it really is in service to everyone in the social sector that is, basically trying to survive while solving complex problems. And it's a hard place.
Thank you so much. That's a great place to end this. I know that we've got, we want folks to be able to leave on time, and there's some survey questions. And I do want to give a plug that there is a workshop that Andrew's offering this month, April 19th, on the 5 essential practices of impact measurement. There's a link in the chat for that, and I'll hand it over to Muska to take it from here. Thanks to everybody. It's a really wonderful conversation.
Wonderful. Thank you so much, Hilary, Sue, Leanne, for very insightful and informative discussions. And of course, to Andrew for sharing such a powerful investment readiness journey with us today. And thank you to our attendees for your engagement. We noticed that there were a ton of great questions and comments, so we really appreciated your participation today.